Thank goodness it's Friday is what the markets are cheering according to SocGen analysts. But with a host of positive data, has the week really been that poor? Joining me on the phone to share his insights is Dr. Sylvain Broyer, economist with Natixis. So Sylvain, we've had the EM currency rout, flash PMIs, a stock exchange shutdown and monetary meeting minutes revealed, to name but a few events this week. But what would you say has been the main market mover, and how would you describe market sentiment at present?
So definitively the main market mover has been the minutes, because expectation of Fed tapering are the common route for the rise in US and German bond yields this week, for the flows from emerging FX markets, which led the Turkish, the Brazilian and the Indian central bank to intervene and defend their currencies. The good shape of economic indicators, you mentioned the flash PMIs, but we also had good US home sales, only confirmed the view of a possible inflection in monetary policies, turning out less expensive. And on that topic, especially, I find that the market sentiment is really scary. Should the Fed taper its bond buying program, the U.S. central bank will have had something like 5 points of world liquidity this year instead of 6 points without tapering. So what? Liquidity is not a concern, and the rise in sovereign yields is absolutely not justified by fundamentals now.
Looking at Europe, just months ago the market was betting for the ECB to cut interest rates. Policymakers have since backtracked slightly. But with this slew of more positive data, are interest rate cuts off the cards for the time being, do you think?
I will not applaud to yesterday Novotny's declaration personally, and that's the case for my colleagues in the Shadow Council. I think there are good reasons for a rate cut in the Eurozone. Sure, the current momentum of economic activity remains passable, but the strong rise in French and German GDP since the second quarter of this year was triggered by seasonal one-offs. If you look at monetary developments are worrying, with M3 at 2.3% growth and M1 decelerating again. Credit standards in the Eurozone are as tight as before, and the unemployment rate is likely to rise by 12.5% until the mid of next year. Moreover, there are many risks to the economy, with the announcement of the modalities, the asset quality review coming soon, the Portugal crisis the political crisis in Portugal that can resolve at every moment, the debate on the new Greek package in the wake of the German elections, and for sure the diktat of European yields on rising US yields. So far the ECB has an explicit loosening bias. It's not for nothing, and I still expect the European Central Bank to deliver a rate cut before the end of this year.
Indeed, investors awaited the FOMC meeting minutes with bated breath. But given that tapering in is largely already priced in, is the Fed telling the market what to do, or is the market telling the Fed what to do?
This is the key question. For now, the markets have decided that interest rates should go up, while the Fed, the ECB, and even the Bank of England are telling them the opposite by means of forward guidance. So what's next? On the one side, I would say excess central bank liquidities have distorted the markets and the economies. Look at the recovery of the UL real estate. It's quite buoyant now. And I think it is time to put that policies to an end, for the sake of the market, for the sake of the economy, and even at the cost of slightly higher interest rates on the long part. But on the other side, I think now that the market has went too far, betting on eternally rising interest rates, liquidity will still be higher next year, as the Bank of Japan will add 4 points of world liquidity next year. And I expect a correction in the next weeks.
The greenback has gained momentum over most of its peers, but do you think economics are going to drive the euro-dollar story rather than the interest rate story going throughout the rest of the year?
We at Natixis expect the dollar to appreciate significantly against the euro, maybe up to 128 until the end of the year, from the currently 133. And the U.S. Treasury and German bonds are more likely to feel the law of gravity once again when the Fed's tapering intentions become clearer, if not at Jackson Hole Symposium, at least by the next FOMC meeting of September 18th.
Sylvain, thank you so much for your time and perspectives today. The TV team have plenty more to bring you viewers before the week is out, so please do keep clicking back to the website. But for now, goodbye.